Hello, everyone, and welcome back to the trading table. Today, we're going to be going over these four stocks that we're looking at if the U.S. joins the Iran Israel conflict. Now, there's obviously things ramping up in the Middle East, and although that is a very bad situation, there is ways to come out of this, in the stock market. So there are numerous reasons why the U.S. would join this conflict. Firstly, the U.S. has a close alliance to Israel, and many members of Congress are in favor of defending Israel. Secondly, protecting oil interests is very, very important. Iran controls the Strait of Hormuz, and 20% of the world's oil passes through there. The biggest reason, though, would be to prevent nuclear escalation. Iran has quite the ambition to develop a nuclear weapon, and there are multiple documents in place saying that they cannot do this, although they are still trying to enrich uranium, which is what began this conflict in the first place, according to media sources. Protecting peace and maintaining as little conflict as possible in the Middle East is also good for the U.S., just to keep oil prices low and such. Low oil prices means low energy prices, which just all circles back around to lower inflation rates. Now, jumping over to Landon to kind of dive in to these stocks that we have chosen out.
Yeah, thank you, Andrew. So, looking at current headlines, this week has been dramatic escalation between Israel and Iran. On June 16th, Iran launched another wave of ballistic missiles and drones, reportedly 350 in total, including dozens on June 16th alone, targeting major Israeli cities like Tel Aviv, Haifa, and excuse me if I butcher these names, but Bnei Brak and Petah Tikva, and even central Jerusalem suburbs. Missile fragments even struck the U.S. Embassy in Tel Aviv. In total, 24 civilians have been killed, including a 10-year-old and elderly woman buried in Bat Yam, with over 90 others injured and at least 287 hospitalized. Also, Israeli air campaigns dubbed Operation Rising Lion have struck Iranian nuclear and military sites in Natanz, Tabriz, and Tehran, reportedly killing dozens of generals, intelligence officers, and nuclear scientists. In fact, Israeli action caused damage at Iran's Karg Island oil terminal and shutdown of its South Pars gas field, which supplies 80% of Iran's gas. Global reactions are firm. The G7 and UN have urged de-escalation. Meanwhile, President Trump has ordered U.S. citizens out of Tehran, hinting at bunker-busting strikes on Iranian nuclear sites, and diverted the USS Nimitz carrier toward the Gulf. And then the way the markets have sort of responded so far, the Dow fell 300 points, the VIX surged, and oil prices spiked, highlighting the sort of elevated risk and volatility. Now, if you want to take us to Exxon, Andrew,
Yeah, Landon.
and
Another
take it from
thing
there.
that I've seen, a lot of people say this online, especially on Twitter, is that the pizza index for the Pentagon is going up. So whenever there's like a war threat imminent, I guess people at the Pentagon, because they can't go home, make food, or go out for food, they order a lot more pizza. So that's kind of an interesting way to gauge whether we go to war or not. Looking out at ExxonMobil, though, which is going to be our first pick for today, the energy space is the first battlefield, according to Reuters. Brent crude jumped 7%, settling above $74 a barrel after the tit for tat strikes. The Guardian reports a surge of $10 a barrel to $78 before stabilizing near $72 to $75. Just to put that into perspective, oil barrels typically range within the 60s, so 70 is a bit high for oil, but nothing too concerning yet. Importantly, Iran's oil exports have plunged from 1.7 million barrels per day just to 100,000 barrels per day, while two major Israeli gas fields, Leviathan and Karish, have suspended production. Even a power station in Haifa was knocked offline. So, what's the market turn here? Oil ETFs jumped and global energy equities gained as investors dialed up risk premiums. Now, you might think that it might be too late to get in. However, we're not even in the war yet. So that means that the move has potentially not even happened yet. With Middle East supply threatened and the Strait of Hormuz still vulnerable, even a whisper of route blockage now carries serious pricing risk. Given this, ExxonMobil, endowed with global production assets, midstream operations, and reserves, is uniquely poised to benefit from sustained price runs. Now going over to Landon for Lockheed Martin.
Yeah, thank you, Andrew. So another great buy here is also Lockheed Martin. Defense spending is surging as the geopolitical stakes rise. U.S. military budgets are being reviewed specifically for bunker buster munitions and missile defense in light of threats from Iran. Lockheed Martin has already secured commanding contracts. For example, a 4.94 billion Army PRSM missile system deal, a $214 million advanced night vision agreement, and a $270 million infrared sensor contract for the Air Force. In quarter one of 2025, they booked 18 billion in revenue, which is plus 4% year over year. Reported net earnings of 1.7 billion. Um, and built a backlog of $173 billion. The market's response to this entire, heated stakes is that Lockheed Martin has leapt about 2.6% on June 17th as risk assets reassess defense exposure.
Yeah, Landon. LMT is always a great buy. Personally, the way I like to play LMT is wait for a time of peace. The price normally likes to sit around $450 whenever we're not, actively in war. Maybe pick up a few shares here and there, and then kind of sit on them because there's always going to be something going on. And another thing about LMT is it might look like it has leaped, it might look like it has made its move. However, when they start whipping out helicopters that can turn invisible in Iran, uh, obviously that's kind of like a hyperbole, but when they start, showing their tech and what they've been cooking up with that $4.94 billion contract, and obviously their huge backlog of $173 billion, they're definitely going to leap a lot more. Moving on to our next one now, though, Northrop Grumman, kind of similar to Lockheed Martin, but Northrop Grumman is more focused at the high tech forefront of today's conflict dynamics. In quarter one of this year, net new contracts awards totaled 10.8 billion, driving its order backlog above 92.8 billion. Revenues were 9.47 billion. EPS hit $6.06, which is just shy of the $6.21 estimate. Sorry, $6.21 estimate. Analyst forecasts next year's EPS near $29, implying a forward PE around 18%. That PE value suggests that Northrop Grumman is potentially undervalued. That doesn't necessarily mean it's going to absolutely fly up. However, it's a good way to gauge that it does have potential to shoot higher because it is undervalued. The stock is trading near $504, up roughly 1.2% on June 17th. With Northrop's strategic edge in stealth bombers, ISR drones, and missile defense, they are directly aligned with modern war theater demands. I don't know if you guys have seen the war in Ukraine and Russia, obviously. There's a lot of drone usage, and I suspect that it's going to be pretty similar if we get involved with this Iran Israel conflict. Jumping over to Landon now for our next stock.
Yeah, thank you, Andrew. So our next stock here is actually HII, ticker symbol Huntington Ingalls Industries. Excuse me. Um, They basically produce shipyards and carriers. Naval power is central to the U.S. military posture in the Persian Gulf. HII, the only U.S. builder of aircraft carriers and nuclear submarines, booked 2.1 billion in new quarter one 2025 awards, raising its backlog to about 48 billion. Operating income grew about 4.5% quarter over quarter to 161 million, with margins at 5.9%, driven by strong performance in shipbuilding and mission technologies. On June 17th, HII climbed about 2.2%, trading near $234 as the U.S. repositions naval assets and strengthens maritime posture near critical zones. Huntington is in a strategic sweet spot, I would say.
Yeah, and that's basically like a free monopoly if you think about it. They're the only company that is allowed to really make aircraft carriers, and they control the shipyards for them and that thing. So they have complete control over that whole market. Obviously, we're not popping out an aircraft carrier every year, but it's definitely good for a growth stock. Just to close now, rising oil, missiles, bombers, and ships underscore the dual market strategy of Exxon, Lockheed, Northrop, and Huntington Ingalls. Whether through energy inflation hedging or defense tech momentum, this portfolio that or these stocks that we've shown you today and talked about align very strongly with current Middle East escalation dynamics. That's all for today, guys. It's just four stocks. We want to see, well, we don't want to see, but This is what we would be looking at if the US was to enter the war. Still watching them because obviously we still kind of fund this war in a way. So even if we don't enter, these stocks can still do good. It's up to you to make that decision if you want to preemptively enter them or not. That's all for today, guys. Thank you so much for tuning into the trading table. If you enjoyed this video, please be sure to like, subscribe, and we'll catch you guys in the next one.